Hello everyone and welcome to Thrifty Tribe. As you read in the title, today's video is about creating a personal financial plan. First, just a side note. If you leave your first name and the state, country, or province you live in, I will give you a shout out on the next video. If you find this content helpful, please like, comment, subscribe, and hit that notification bell so you don't miss any upcoming videos. Okay, let's get started. How to define your financial goals. Do you want to achieve financial success? If so, the first step is to define your financial goals. What do you want to achieve with your money? Do you want to save for a down payment on a house? Pay off your debt? Retire early? Once you know what you want to achieve, you can start to develop a plan to reach your goals. This plan will need to take into account your current financial situation, your income, and your expenses. It's also important to set realistic goals that you can actually achieve. Here are some tips for defining your financial goals. Make sure your goals are specific. Don't just say you want to be rich. Instead, say something like, I want to save $10,000 for a down payment on a house in 5 years. Make your goals are measurable. How will you know when you've achieved your goal? For example, if you're saving for a down payment on a house, you can track your progress by tracking your savings account balance. Make your goals attainable. Don't set yourself up for failure by setting unrealistic goals. If you're currently living paycheck to paycheck, don't try to save $10,000 in a year. Start with a smaller goal, like saving $1,000 in 6 months. Make your goals relevant. Your financial goals should be relevant to your life and your priorities. If you're not interested in owning a home, don't set a goal to save for a down payment. Make your goals time-bound. Set a deadline for achieving your goal. This will help you stay motivated and on track. Once you've defined your financial goals, you can start to develop a plan to reach them. This plan should include a budget, a savings plan, and an investment plan. A budget will help you track your income and expenses so you can see where your money is going. A savings plan will help you set aside money each month to reach your financial goals. And an investment plan will help you grow your money over time. By following these tips, you can define your financial goals and develop a plan to reach them. With hard work and dedication, you can achieve financial success. If you want to achieve financial success, the first step is to assess your current financial situation. This means taking a close look at your income, expenses, assets, and liabilities. By understanding your current financial situation, you can identify areas where you can improve and make a plan to reach your financial goals. Here are some tips for assessing your current financial situation. Track your income and expenses. The first step to assessing your financial situation is to track your income and expenses. This will give you a clear picture of where your money is going each month. There are a number of different ways to track your income and expenses, such as using a budgeting app, a spreadsheet, or simply writing down your spending in a notebook. Calculate your net worth. Your net worth is the total value of your assets, minus your liabilities. To calculate your net worth, you need to add up the value of everything you own, such as your home, car, investments, and savings. Then you need to subtract all of your debts, such as your mortgage, car loan, and credit card debt. Review your credit report. Your credit report is a record of your financial history. It includes information about your credit accounts, your payment history, and your credit inquiries. You can get a free copy of your credit report from each of the 3 major credit bureaus once a year at annualcreditreport.com. Get professional help. If you're struggling to assess your financial situation on your own, you may want to consider getting professional help from a financial advisor. A financial advisor can help you understand your financial situation and create a plan to reach your financial goals. Once you've assessed your current financial situation, you can start to make a plan to improve your financial health. This plan may include setting financial goals, creating a budget, and paying down debt. By taking the time to assess your financial situation, you can take control of your finances and achieve financial success. How to create a budget. If you want to achieve financial success, you need to create a budget. A budget is a plan for how you will spend your money. It helps you track your income and expenses so you can see where your money is going and make adjustments as needed. Creating a budget can seem daunting, but it doesn't have to be. Here are a few simple steps to help you get started. Gather your financial information. This includes your income statements, your bank statements, and your credit card statements. Categorize your expenses. This will help you see where your money is going. Some common categories include housing, transportation, food, clothing, entertainment, and debt payments. Estimate your monthly expenses. This may involve some guesswork, but it's important to be as accurate as possible. Subtract your expenses from your income. This will give you a surplus or deficit. If you have a surplus, you can use it to save or pay down debt. If you have a deficit, you need to find ways to cut back on your expenses. Review your budget regularly. Your budget is a living document, so you need to review it regularly and make adjustments as needed. Here are some examples of how to create a budget. Fixed expenses. These are expenses that stay the same from month to month, such as your rent or mortgage payment, car payment, insurance premiums, and utility bills. Variable expenses. These are expenses that can vary from month to month, such as groceries, gas, dining out, entertainment. Discretionary expenses. These are expenses that you can choose to spend or not spend, such as clothing, gifts, and vacations. Once you have created your budget, you can start to track your spending. There are a number of different ways to track your spending, such as using a budgeting app, a spreadsheet, or simply writing down your spending in a notebook. Tracking your spending will help you see where your money is going and make adjustments to your budget as needed. It will also help you stay on track and reach your financial goals. Here are some tips for tracking your spending. Be as accurate as possible. This means writing down every penny you spend, no matter how small. Track your spending for at least 1 month. This will give you a good idea of your spending habits. Review your spending regularly. This will help you identify areas where you can cut back. Make adjustments to your budget as needed. This is an ongoing process, so don't be afraid to make changes as your financial situation changes. Creating a budget and tracking your spending are essential steps to financial success. By following these tips, you can take control of your finances and achieve your financial goals. Create an emergency fund. If you want to be financially secure, you need to have an emergency fund. An emergency fund is a savings account that you set aside for unexpected expenses, such as a job loss, a medical emergency, or a car repair. Having an emergency fund can give you peace of mind knowing that you have money set aside to cover unexpected expenses. This can help you avoid going into debt or having to borrow money from friends or family. How to create an emergency fund. There are a few simple steps to creating an emergency fund. Set a goal. How much money do you want to have in your emergency fund? The amount you need will depend on your individual circumstances. A good rule of thumb is to have 3 to 6 months of living expenses saved up. Make a budget. Once you know how much money you need to create a budget to help you save. A budget will help you track your income and expenses so you can see where your money is going. Automate your savings. One of the best ways to save money is to automate your savings. This means setting up a recurring transfer from your checking account to your savings account on a regular basis. Cut back on your expenses. If you need to save more money, you may need to cut back on your expenses. This could mean eating out less, canceling unnecessary subscriptions, or finding cheaper ways to get around. Be patient. It takes time to build an emergency fund. Don't get discouraged if you don't reach your goal overnight. Just keep saving and you will eventually reach your goal. How much should be saved? The amount of money you should save for your emergency fund will depend on your individual circumstances. However, a good rule of thumb is to have 3 to 6 months of living expenses saved up. This means having enough money to cover your essential expenses such as rent or mortgage payments, food, and utilities. For 3 to 6 months if you lose your job or experience another financial setback. There are many benefits to setting up an emergency fund. Here are a few of the most important. Peace of mind. Having an emergency fund can give you peace of mind knowing that you have money set aside to cover unexpected expenses. This can help you avoid going into debt or having to borrow money from friends or family. Financial security. An emergency fund can help you protect your financial security in the event of an unexpected expense. This can help you avoid having to make difficult choices, such as cutting back on essential expenses or selling assets. Improved credit score. Having an emergency fund can help you improve your credit score. This is because lenders look favorably on borrowers who have a history of managing their finances responsibly. Financial freedom. An emergency fund can help you achieve financial freedom by giving you the peace of mind to take risks and pursue your financial goals. How to manage your debt. If you're struggling with debt, you're not alone. Millions of people in the United States are in debt. Debt can be a major source of stress and anxiety, and it can make it difficult to achieve your financial goals. But there is hope. There are a number of things you can do to manage your debt and get out of debt. Here are a few tips. Take stock of your debt. The first step to managing your debt is to take stock of your current situation. This means knowing how much debt you have, what interest rates you're paying, and when your debts are due. Create a budget. Once you know how much debt you have, you need to create a budget. A budget will help you track your income and expenses so you can see where your money is going. This will help you identify areas where you can cut back on spending so you can free up more money to pay down your debt. Pay more than the minimum. If you can, try to pay more than the minimum on your debts each month. This will help you pay down your debt faster and save money on interest. Consider consolidating your debt. If you have multiple debts with high interest rates, you may want to consider consolidating your debt into one loan with a lower interest rate. This can save you money on interest and make it easier to manage your payments. Get help from a credit counselor. If you're struggling to manage your debt on your own, you may want to consider getting help from a credit counselor. A credit counselor can help you create a debt management plan and negotiate with your creditors to lower your interest rates and monthly payments. Managing your debt can be a daunting task, but it's important to remember that you're not alone. There are a number of resources available to help you get out of debt. With hard work and dedication, you can achieve financial freedom. Savings and investments. The key to financial security. If you want to achieve financial security, you need to save and invest your money. Saving money means putting money aside for future expenses, such as a down payment on a house or retirement. Investing money means putting your money to work in an attempt to grow your wealth over time. Saving and investing are not mutually exclusive. You can do both at the same time. In fact, it's a good idea to do both if you want to achieve financial security. Saving money. There are a few different ways to save money. One way is to open a savings account. Savings accounts typically offer a low interest rate, but they are a safe place to store your money. Another way to save money is to invest in a money market fund. Money market funds are a type of mutual fund that invest in short-term debt securities. They typically offer a higher interest rate than savings accounts, but they're not as safe. Investing money. There are a variety of ways to invest money. Some common investment options include stocks, bonds, and mutual funds. Stocks are shares of ownership in a company. Bonds are loans that you make to a company or government. Mutual funds are baskets of stocks or bonds that are managed by a professional investor. The best investment for you will depend on your individual circumstances and risk tolerance. If you are risk-averse, you may want to consider investing in bonds or money market funds. If you are willing to take on more risk, you may want to consider investing in stocks. The importance of saving and investing. Saving and investing are important for a number of reasons. First, they can help you achieve financial security. By saving money, you will have a financial cushion in case of unexpected expenses. By investing money, you can grow your wealth over time and reach your financial goals, such as buying a house or retiring early. Second, saving and investing can help you reduce your reliance on debt. If you have a lot of debt, it can be difficult to save money or invest. By paying down your debt, you will free up more money to save and invest. Third, saving and investing can help you improve your credit score. Lenders look favorably on borrowers who have a history of saving and investing. This can make it easier for you to get a loan in the future, such as a mortgage or a car loan. The importance of insurance coverage. In today's world, it is more important than ever to have insurance coverage. Insurance can protect you from financial loss in the event of an unexpected event, such as a car accident, a natural disaster, or a medical emergency. There are many different types of insurance available, so it is important to choose the right coverage for your needs. Some common types of insurance include auto insurance. This type of insurance covers you in the event of an accident. It can also cover damage to your car and medical expenses if you are injured in an accident. Homeowners insurance. This type of insurance covers your home and belongings in the event of a fire, theft, or other disaster. Health insurance. This type of insurance covers your medical expenses. It can also cover prescription drugs and other healthcare costs. Life insurance. This type of insurance provides financial protection for your loved ones in the event of your death. The amount of insurance coverage you need will depend on your individual circumstances. If you have a lot of assets, you may need more insurance coverage than someone who does not have as much. You should also consider your income and expenses. If you have a high income, you may be able to afford more insurance coverage than someone who has a lower income. When choosing insurance coverage, it is important to compare different policies and prices. You should also make sure that you understand the terms of the policy and what is covered. It is a good idea to talk to an insurance agent to get help choosing the right coverage for your needs. Insurance coverage is important for a number of reasons. First, it can help you protect your financial assets. If you have insurance, you will not have to pay for unexpected expenses out of pocket. This can help you avoid going into debt or having to sell assets. Second, insurance coverage can help you avoid financial hardship. If you are injured or your home is damaged, insurance can help you pay for the repairs or medical expenses. This can help you get back on your feet and avoid financial ruin. Third, insurance coverage can help you protect your loved ones. If you die, insurance can provide financial support for your family. This can help them pay for expenses such as your funeral, medical bills, and living expenses. The importance of estate planning. Estate planning is the process of deciding what will happen to your assets after you die. It includes deciding who will inherit your assets, how they will be distributed, and how any taxes will be paid. Estate planning is important for a number of reasons. First, it can help you ensure that your assets are distributed according to your wishes. This can be especially important if you have minor children or other dependents. Second, estate planning can help you reduce or avoid estate taxes. Estate taxes are taxes that are imposed on the transfer of assets at death. By planning ahead, you can take steps to reduce the amount of estate taxes that your heirs will have to pay. Third, estate planning can help you protect your assets from creditors. If you have creditors, they may be able to seize your assets after you die. By planning ahead, you can put your assets in a trust or other vehicle that will protect them from creditors. Types of estate planning. There are a number of different types of estate planning documents that you may need. Some common types of estate planning documents include will. A will is a legal document that specifies how your assets will be distributed after you die. Trust. A trust is a legal arrangement that allows you to control how your assets are managed and distributed after you die. Power of attorney. A power of attorney is a legal document that allows you to appoint someone to make decisions on your behalf if you become incapacitated. Living will. A living will is a legal document that specifies your wishes for end-of-life care. The importance of getting professional help. Estate planning is a complex process. It is important to get professional help from an estate planning attorney. An estate planning attorney can help you understand your options and create estate planning documents that meet your specific needs. Monitoring and reviewing your financial plan. Your financial plan is a roadmap to help you achieve your financial goals. But as your life changes, so too should your financial plan. That's why it's important to monitor and review your financial plan regularly. How often should you review your financial plan? The frequency with which you review your financial plan will depend on your individual circumstances. If you have a lot of changes happening in your life, such as a new job, a new baby, or a major purchase, you may need to review your financial plan more often. However, even if your life is relatively stable, you should still review your financial plan at least once a year. What should you review when you review your financial plan? When you review your financial plan, you should consider the following: your income and expenses, your savings and investments, your debt, your insurance coverage, your retirement goals, your estate planning goals. How can you monitor your financial plan? There are a number of ways to monitor your financial plan. You can track your income and expenses. This will help you see where your money is going and make sure that you are on track to meet your financial goals. Review your savings and investments. This will help you make sure that your investments are aligned with your risk tolerance and financial goals. Track your debt. This will help you make sure that you're making progress on paying down your debt. Review your insurance coverage. This will help you make sure that you have the right coverage for your needs. Review your retirement goals. This will help you make sure that you are saving enough money for retirement. Review your estate planning goals. This will help you make sure that your assets are distributed according to your wishes. How can you review your financial plan? There are a number of ways to review your financial plan. You can meet with a financial advisor. A financial advisor can help you review your financial plan and make sure that it is still on track. Use a financial planning software program. There are a number of financial planning software programs available that can help you track your income and expenses, manage your investments, and review your financial plan. Do it yourself. If you are comfortable managing your own finances, you can review your financial plan on your own. However, it is important to make sure that you have a good understanding of your finances before you do this. In conclusion, here are some of the key points to remember about financial planning. Define your financial goals. What do you want to achieve with your finances? Do you want to buy a house, save for retirement, pay off debt? Once you know your goals, you can start to develop a plan to achieve them. Create a budget. A budget is a roadmap for your finances. It helps you track your income and expenses so you can see where your money is going. Save money. Saving money is essential for achieving your financial goals. There are a number of ways to save money, such as setting up a savings account, contributing to a retirement plan, or cutting back on unnecessary expenses. Invest your money. Investing your money can help it grow over time. There are a number of different investment options available, so you can choose the ones that are right for you. Monitor and review your financial plan regularly. Your financial situation is constantly changing, so it's important to review your financial plan regularly to make sure it's still on track. By following these tips, you can create a financial plan that will help you achieve your financial goals.